Hi, I'm Eddie Blanco, and today I'm going to be talking about Jerome Powell's recent discussion related to the Federal Reserve policy and how that might impact you as a citizen of the United States and potentially an investor. But whether you're investing in real estate, in the stock market, in the bonds market, or you're just curious about what's happening with your taxpayer dollars, I think it's important that you tune into this video. I'm going to be talking about his conversation, what he said about inflation, what he said about quantitative easing, and really what the impact can be on you. Now, I'd like to put a preface, right, that I'm not a CPA, I'm not an attorney, I'm not a financial advisor. I am a real estate investor and a real estate broker and a lender. And so I understand a little bit about real estate, but what really puts me able to talk about this is the smarter people I know in high places who share a lot of good information for me. And then I do some research and put together these thoughts and ideas for you. My intention with this is not to be purely educational. However, the intention of this video is to provide some idea about what might be happening and pique your interest so that you can do some further research and come up to your own conclusions. I'm not purely speculating here. There's just some information for you to take home and then maybe do your own research and come up to your own conclusions. All right, so it's important to get this backstory so that people really understand. In 2008, we had this financial crisis, and then the federal government started following the recommendations of the Federal Reserve and lowering the interest rates. They lowered interest rates to just about zero and to create economic stimulus. The way that works is simple. The Federal Reserve supplies money to the banks then lend money to businesses. The businesses employ more people, buy more goods and services, buy more things. And as a result of buying these more things, stimulate the economy grows, and then everybody's happy, right? Well, that didn't quite happen. The lowering of interest rate wasn't quite enough to create the stimulus that we were looking for. And so what the government started doing through the Federal Reserve's recommendation is to borrow money to purchase bonds and mortgage-backed securities. They're buying U.S. Treasury bonds, basically saying the Federal Reserve says, I'll buy U.S. Treasuries, and then when the U.S. government is in a better financial position, we'll get paid back slowly over time. So basically the government borrowing money from the Federal Reserve. And then they were also buying mortgage-backed securities. And the way that works is they buy mortgage-backed securities. That lets Fannie Mae and Freddie Mac borrow more, gives money back to Fannie Mae and Freddie Mac. Freddie Mae and Freddie Mac buy more mortgages from your banks, and you can get more mortgages that way. Simple process, and it's been happening consistently since 2008 at different amounts. When in 2017, when they tried to back off of doing that a little bit, softening off buying mortgage-backed securities, it created quite an interesting real estate market, and the real estate market started to slow down a bit. Let's fast forward to today. Today, the Federal Reserve is purchasing, the federal government is purchasing bonds at the tune of $80 billion and purchasing mortgage-backed securities at the tune of $40 billion every month. So what this does is it creates like a fake investor in the market, propping up values temporarily so that we can get through the bad times. And then eventually they can back out of buying these things and the private sector will fill the gap. That's the idea. The problem with this is pumping all this money into the economy could potentially create inflation. And we've already started to see some signs of inflation. But Mr. Powell really downplayed a lot of the inflation we're seeing and said that we're only seeing inflation in certain markets and that inflation is not such a big deal right now. And we're not so concerned about inflation right now. And I'm not anywhere near as smart as this guy, but this is what he's saying and I'm going along with it, right? So the question becomes this. The Federal Reserve the federal government's in a tricky situation because of this. If they stop buying mortgage-backed securities, interest rates will go up. And if interest rates go up, real estate values will probably come down. And if they stop buying in the bond market, the bond yields will go up and the money that's in the stock market will probably move over to the bond market, causing the stock market to come down. So they can't quite put the brakes on the gas pedal. The gas pedal is pedal to the metal right now, and that's causing all this economic stimulus. So when you have the gas pedal to the metal, it can cause inflation. So that's the problem. If you go too fast, you get inflation. If you go too slow, you can cause the markets to crash. So the Federal Reserve is playing that card. Now, you may have heard this term called tapering, and that's essentially what the Federal Reserve is talking about doing at some future point. Now, he was very clear, Mr. Powell, that they were not going to be doing this until at least till the end, after this end of this year. So they're not going to put a brake on the system. They're going to continue spending $120 billion to buy these securities and treasuries, propping up the market, because they say the inflation that we've seen isn't terrible. So what we need to be watching for is, when are they going to start tapering? When are they going to start backing down on buying mortgage-backed securities? When are they going to stop tapering down on buying bonds, U.S. bonds? And when they start taking back, say, hey, instead of 80 billion, let's only buy 70 billion of treasuries. Instead of 40 billion in mortgage-backed securities, let's only buy 30 billion in mortgage-backed securities, and see how the market responds. The Federal Reserve is going to have to start doing this at some point, and they said they will start doing this, but they made it very clear they're not going to do it this year. So what does that mean for us that are in the real estate business? The way I see it, and what's my take on what's going to happen, is that we're probably going to keep pedal to the metal, like he said, all the way through the year. I'm going to take his word on that. The Federal Reserve has one thing: when they say they're going to do something, generally they follow through with it. And the stock market and the markets kind of have been following them, and kind of, you'll see the markets adjust to what they say pretty much quickly. So again, I'm not a specialist in this. I am, though, speculating about what I can see happening. What I see happening is that we're going to continue doing this trend, and we're probably going to see inflation grow. And I don't see them coming off of the mortgage-backed security purchases, because if they do, interest rates will go up, home purchases will slow down, and that'll cause a market issue big time. So what do I say to people that want to say, so it's now the right time to buy? And what I say to people always is, it's always the right time to buy if you're not speculating, and if your intention is to buy long term. Because here's the reality: if interest rates go up, affordability will go down. And even though prices might come down, interest rates will go up. It's kind of like it's tied together, right? The most likely way that property values will go down is because interest rates went up. Well, then affordability stayed the same or got worse. So my point to you is that if you're going to buy, now is the right time to buy, because interest rates are low and you get to lock that in. And even if we have a momentary downturn in values, you have a 30-year mortgage locked in at a very low interest rate, which is not likely to go any lower than it is today. Not much, at least not significant enough. So my answer to you is, yes, you should be buying, as long as you plan on holding longer than 7 years, 7 years or longer. That's kind of my threshold. Some people might say 5 years. I've seen the market cycle, and generally it's 7 years or so before the market comes back to I think 2008 was maybe an exception to that, and it went to like 7 or 8 years, maybe 10 years before we got back to 2008 numbers. So it was 2018 before the values were, in most markets, before the values were 2008 numbers again. In some markets it got corrected faster, in some markets it still hasn't even fully corrected, right? But generally, a 7 to 10 year range is a good number. So if you're thinking you might be changing jobs or getting married or getting divorced or whatever the case might be, within the 7 year period, it may be a better time to hold. This is more of a personal decision than it is a real estate decision. So that's my take on that. The same is true for investment properties. If you can buy a property today with a good down payment, I would say 20% or more, you have equity in the property, and you're willing to buy that property for the long haul, 7, 10 years, and the property cash flows, then it makes sense to buy it. But that's always been the case with real estate. If you can mortgage the property at 20% or more down, and you can cash flow the property, then it's a no-brainer to buy that property. The likelihood that rents are going to go down is not very high. The most likely thing is that we're going to experience inflation. And if we experience inflation, the best place to have your money tied up is, in my opinion, is real estate. Of course, I'm biased, but that's my take. Now, here's what I would caution against. Do not leverage your own home that you live in to buy investment properties. I've seen that mistake happen. Don't tap into your home equity line to make improvements on your home now. Keep your loan to value where it is. If you want to refinance to lower your interest rate, you haven't taken advantage of that yet, do that. But don't get crazy on speculation. I caution against new construction, speculation. I caution against land acquisition, speculation. I caution against buying a property that's upside down, meaning that after you put 20% down and you have a tenant in there, the property's not cash flowing, you shouldn't be buying that property because you don't have any room to go and it's not a good place to be. Also, I would stay away from anything that's not a fixed long-term financing. You don't want to be in a position 6 years, 7 years, 5 years from now where you're having to refinance the property when interest rates might be out of control. You don't know. So lock in that low interest rate, go in for the long haul, and keep your eye on what the government's doing as it relates to quantitative easing. Pay attention to the stock market, pay attention to the bond market, and pay attention to what the government is doing as it relates to quantitative easing. I hope you found this information helpful and informative. If you did, have any questions or have any comments, please comment below and like and share this video with others. And if you want to see more videos like this, please encourage you to subscribe. You can also follow us on Instagram at Stratwell. My name is Eddie Blanco, the broker of Stratwell. Looking forward to talking to you next time. Take care.